what the Federal Reserve realized all of a sudden is inflation is not transitory and we have to increase interest rates quickly. Hey guys, Omar Khan here from Theta Trading, and I want to talk to you today about what these interest rate changes mean for us as investors. Now, the Federal Reserve increased interest rates in the United States by 75 basis points. That's almost 1%, so that's 3/4%. Now, and they're expecting a few more of these to come, maybe another 50 point after that. And the question is, first of all, why are they doing this, okay? So let's go back in history and talk about why they're doing this. First things first. 2 years ago when COVID hit, the world came to a grinding halt, absolute grinding halt. And the only way that the central banks could resolve these issues was to print money. And when you print money, you cause inflation. But that's what the time required. That's what we needed back then. We needed them to print money, because if they didn't print money, there would have been mass unemployment, all kinds of issues where people wouldn't be able to, social issues. So what they did was they printed money and they handed out a bunch of free money to people. Now, that is what we're paying the price for now, okay? So think about it. March 2020, February 2020, everything's fine. All of a sudden, bam, COVID hits. And they start printing money, left, right, and center, printing trillions and trillions of dollars. Now, this money eventually, now let's just look at the definition of what inflation is. Inflation is too much money chasing too few goods and services. That is the definition of inflation. So that's the backdrop. 2.5 years ago or 2 years ago, printed a bunch of money so that we could get through that really tough economic time. And things were rosy. Markets went down, they rebounded pretty well. The world was still in lockdown, but people were able to live because the governments were giving them money. They were subsidizing stuff. Now that made life a lot easier back then. So let's flash forward to now what's going on. So now money's been printed, a bunch of money is in circulation, and we also have supply chain issues. Now supply chain issues means that because of COVID, things weren't being produced as readily as they used to be, right? There was disruptions. China had lockdowns, which is the manufacturing hub of the world. You had various items that were backlogged, like chips, cars, shipping across Atlantic and Pacific Ocean, like all kinds of things were backlogged. And that means, again, less goods and services available for purchase. And on top of that, a lot of money in the system, okay? So that's the backdrop of what happened. Now, let's flash forward. So last year, the Federal Reserve, Jerome Powell, started talking about inflation as being the word called transitory. It's only going to be here for a little while. But as the data kept coming out last year, everyone kept saying, okay, it's transitory. And then more data came out. And we realized, this is not transitory. This is for real, right? And you can see it, for you guys can see it at the grocery stores, you can see it at the gas pump, you can see it anywhere you go. Food items, you go to a restaurant. If you want to buy certain things like a PlayStation 5 or something, they're not even available. You want to buy a car, there's a wait list. Sometimes even over a year for a wait list. So again, this is too much money chasing too few goods and services. If you combine that with the supply chain issues we've had, you have inflation. Now, inflation is running in the United States north of 8%. That's big, right? And the Federal Reserve wants to get that down to about 2 to 3%. So now let's take a look at what that means to us as investors. First, let's look at the stock side, okay? The stock market is a leading indicator. The stock market is pricing in today what it thinks corporate earnings are going to be like a year from now, okay? So today, and then what does that mean 12 months from now? So if I were to value Microsoft stock today, well, what the market's saying is I'm looking at seeing what Microsoft's corporate profitability will be like in a year from now. Now, ultimately, companies are valued based upon the amount of money they make or don't make in the long term. In the short run, as Charlie Munger said, the stock market is a popularity contest. In the long run, it's a weighing machine, and that weighing machine depends on earnings. So the stock market this year, starting at the start of the year, realized that inflation is not transitory. It's real and it's pretty high. And it said, uh-oh, we have to start selling off stocks. Why? Because companies that make money oftentimes borrow money to make money, okay? So if you're borrowing money to make money and now all of a sudden the cost to borrow money is increasing, well, that means your corporate profitability will decline. Second thing is, if we have a lot of inflation, eventually that could lead to unemployment, which means people would stop spending money, right? Which again would lower corporate profitability. So the stock market started selling off on January 3rd, and it's been a precipitous decline since then. It's been nasty. It's one of the nastiest ones I've seen in my life. I have been investing since 1998, and this is the third worst one I've seen. 01, 02 was horrible, 08, 09 was horrible, and now this one. But this one feels very different. So the stock market sold off, like I said, considerably. I'll get back to why this one feels so different. So the stock market sold off substantially. And what the Federal Reserve realized all of a sudden is that inflation is not transitory, and we have to increase interest rates quickly. Right? So now they're starting to increase rates really fast, right? And we just had on Wednesday, I'm recording this on Friday, June 17th, Wednesday, June 15th, the Federal Reserve increased interest rates by 75 basis points. Now, this is going to have a lot of effects in the economy. People are not going to borrow as much money. They're not going to borrow money to start new businesses. They're not going to take out loans to improve their home. They're not going to buy as many properties. All these things, what does that do? That lowers the demand for goods and services. So what the Federal Reserve is trying to do is they're trying to lower the demand for goods and services, therefore lower inflation, and therefore not cause runaway inflation. Because runaway inflation is horrible for all of us. And that's the one thing that the Federal Reserve is really, really trying to avoid. Now, they're playing a tough game here. They have to do this while managing not to put the economy into a major recession. So in the first quarter of this year, the United States, we had negative GDP growth, which means the gross domestic product of the country was actually negative. Now, recession is defined as 2 consecutive negative quarters of GDP growth. Okay, that's the classic definition. Now, if this second quarter comes in again with negative GDP growth, well, we've got a bit of a problem. So now we're in a full-blown recession. Now the question is, maybe you guys have heard this term, is it going to be a hard landing or a soft landing? Now the stock market doesn't know if it's going to be a hard landing or a soft landing. All it's seeing is interest rates are going up, and they're going to be going up more, and those demand for goods and services are going to come down. But what the stock market doesn't know yet, and the stock market hates uncertainty, is how badly is this going to affect the economy? Is it going to be a soft landing? Is it going to be a hard landing? We don't know. So the stock market is just selling off irrationally, maybe in some cases. And that's what the stock market does. Oftentimes it gets very irrational on the upside, and it gets very irrational on the downside. So now we've had a major sell-off. The NASDAQ is down 34.3% as of from its all-time high. The S&P 500 is down 23% from its all-time high. These are big declines. Now, those are both bear markets. Bear markets are declined as drops of greater than 20%. They don't happen all that often, but they do happen. So that's what that's meant on the stock side. Now, the stock market is starting to look for some positive data. What it's looking for is a few different things. It's looking for an end to this horrible war in the Ukraine. And I feel horrible for the people who have to deal with the ramifications of that war, all the destruction, and it's awful. If the war ends, what happens is gas prices will fall considerably. Therefore, people aren't spending as much on gas. Grocery prices should fall. All these things will cause inflation to go down. So that's one of the things the market's looking for. The second thing the market's looking for is it's looking for demand destruction. When you keep raising rates like I talked about, eventually people stop spending. So this is what the Federal Reserve is trying to do. They're trying to slow the economy down while not crashing the economy. And it's not easy. That's why you keep hearing this hard landing, soft landing. Which one is it going to be? We don't know. And right now it's uncertain. And that's what the stock market is in such a foul mood about. Okay. Now that's what it means for the stock market. Now remember, stock market's looking forward 12 months. It's taken the brunt of all this already. You know, in my opinion, we're probably pretty close to the end, maybe even at the end, or, you know, very close. I don't know for sure, but, you know, I've been around long enough to know that markets, when they decline, they don't decline forever. At some point in time, they stop and people say, wow, there are so many good deals in the markets. And you know what? These companies are going to make a lot more money in the future. Like, ask yourself, does it really change a lot of things? Is Microsoft going to make less money? Is Apple going to make less money? Is Tesla going to sell less cars? These are just a few examples. You have to ask yourself, whatever companies that you're investing in, how much of a material impact is this going to have on the earnings of that company? Okay, so that is the stock market. Now, the second part is, what does this mean for the real estate market? Well, the real estate market is a lagging indicator. And I talked about the stock market looking forward 12 months. The real estate market is a lagging indicator. It only reacts after the fact. So now we've had a few interest rate hikes, and I'm already starting to see it. I live here in Toronto, Canada, and I'm already starting to see property values decline. Why? Think about it. Before, if you were getting a $500,000 mortgage or $1 million mortgage, and now it costs you considerably more, 30, 40, 50% more in monthly carrying cost. Because why? Interest rates are going up because the Federal Reserve has to do it to slow the economy down. Well, now people are saying, well, I can't afford this home. The bank's saying, we don't want to lend you money for this home. Now you're starting to see the effects on the real estate side. Now, the real estate market, depending on how many more interest rate hikes we have, and I'm a big real estate investor as well, depending on how many more interest rate hikes we have, that is going to determine how destructive this is for real estate. So again, stock market has already taken a beating because it's a leading indicator. Now, the real estate market is going to get hit. And what we're all waiting to see is, what does this mean at the end of the day to corporate profitability? So for example, if all of a sudden real estate collapses, well, that means people are going to have less money to spend. They're not going to go out and eat. They're not going to go on vacation. They're not going to buy stuff. That's going to cause a problem for corporate profitability. But what we don't know yet is how bad this will get or not get. Now, I talked about this earlier, why this feels different. I've been through a few recessions in my life. 01, 02 was really bad. 08, 09 felt like the world was coming to an end. This one doesn't feel the same way, and I'll tell you why. This is the first time I've seen a recession and a big market decline, and jobs are still abundant. In fact, this morning I went out to get some breakfast and saw a few help wanted signs already. So these help wanted signs are everywhere, and also it's evident in the data. Last month, the United States created 390,000 jobs, not lost, created. So now, what does that mean? That means jobs are still being created. That means companies are still looking for people to work. But it just seems like not as many people are interested in working as they once used to be. And this could be one of the psychological changes that we encountered because of COVID. Now, this is what the overall picture is. So that's why the stock market's getting hit. That's why the real estate market is now starting to get. Now, what we're going to focus on, like I said, is we're going to focus on hopefully an end of the war and getting inflation down. Once the stock market starts seeing that, it's going to get in a much better mood. The real estate market, it's probably going to hurt for a bit more until these interest rates filter into the economy and people adjust to buying homes and property values adjust. But what I think will happen eventually is, and this kind of happens most often, is the Federal Reserve will probably hike interest rates too high, maybe put the economy into more of a recession than they wanted to, and then all of a sudden may have to reverse course and start dropping rates. Now that would be pretty good for the stock market, and the real estate market will eventually appreciate lower rates as well. So that's what these interest rate hikes mean to us, guys. I hope you guys enjoyed this video. If you did, please hit that like button, subscribe, and also leave some comments. What kind of videos would you guys like to see in the future? Anyways, guys, Omar Khan from Theta Trading. We'll talk to you all soon.